Good afternoon. Assalamu alaikum. I'm Safa Al-Tayyib Al-Kogali. I'm the country director covering the GCC countries for the World Bank. I'm delighted to moderate this session. I'm very honored for you joining us. This session on unlocking market finance for development is really critical because, as you know, at the G20, there was a call on multilateral development banks, such as the World Bank and other banks, to play a role to try and usher in private financing to help in addressing some of the global challenges, like climate change, like poverty, like food insecurity. And to be able to really do that, we need to kind of see what are the trends. How has private capital been flowing into developing countries? Where is it that we can do more? And so I'm really delighted to have my colleague from MIGA, which is the Multilateral Investment Guarantee Agency, one of the World Bank Group agencies, who is also the author of a report on the state of private finance for development. He will make a presentation, and I hope we can listen and have a discussion with all of you here in terms of what more can be done and how it can be done. How can we enhance the role of multilateral development banks? And just a quick word around, on MIGA. And so MIGA is the Multilateral Investment Guarantee Agency. It promotes foreign investment into developing countries by issuing political risk insurance to private investors. It also provides guarantees against the non-honoring of financial obligations of sovereign, sub-sovereign, and state-owned enterprises, and it also provides trade finance guarantees. So over the years, MIGA has been providing a portfolio of guarantees, and as of the end of June 2023, our gross portfolio exceeded $27 billion. So what we hope really, again, as I said in this session, is to see how we can catalyze private capital flows into developing countries. I don't want to take too much of your time. I'd like to introduce my colleague, Dilip, and who will walk you through the presentation, and then we'll open it up for questions, answers, and a discussion. Thank you.
Thank you, Safa. So there is a report that looks like the photo over there called Market Finance for Development, Taking Stock. And it's a hard copy report, and we have just circulated one pager. So that has the executive summary, so to say. And the report is also available online. Now, the context for this, and I'll leave the messages there, I'll go through them. The context for this is that we are talking about trillions of dollars in financing needs for climate change, addressing climate change, for addressing the challenges of food insecurity, for fragility. And we know that official financing is not going to be enough, so there is that need to bring in, catalyze private capital, to private capital mobilization. And an interesting question would be, okay, so if we are going to step up efforts on private capital mobilization, where are we now? How have we been doing? What is working, what is not working? So with that in mind, we put together a database which is rather unique, and you will see some of that in the presentation. And we decided to take a look at what has happened since the turn of the century, so from the year 2000 to 2022. Because the report was prepared 6 months ago, I mean, the work was done 6 months ago, or last 6 months. It was published in December. At that time, data was available only up to 2022. Even now, most of the data are not available for most of the countries for 23. We are just in February, early February. So with that, the three messages that are coming out are that private capital flows to developing countries are actually in retreat, even as the needs are higher. The retreat is led by foreign direct investment, which has always been the largest source of private capital flow to developing countries. And portfolio flows through the bond market and the stock market have also been falling. And the decline actually is led in a way by north-south flows. By contrast, south-south flows are increasing and remittances are increasing. Official flows, especially through the MDBs, are expected to and can actually support our efforts to mobilize more capital. So those are the three key messages. And some charts to show the actual data. So in this chart, you see the flow of all private capital flows. So all private capital, that is foreign direct investment, equity investment that go through the stock market. So we call it portfolio investment of equity, portfolio equity. Portfolio debt, which is flows through the bond market. And syndicated bank lending, which is commercial bank lending. All of that put together, that's the capital flow item, that's a financing item. The numbers are now looking down or sideways, but for sure they are very, very volatile. So they are down and volatile. Since the global financial crisis in 2007, we really have not recovered. That's a surprise because it seems like we are all fine. Not only that, we even had a pandemic and seems like we are all fine, but actually not so. So private capital flows have been falling. If you included China in the group of low and middle income countries, which I call within quotes developing countries, then the flows are down by 58%. If you excluded China, because China is a universe unto its own, it's just a very different dynamics there. Excluding China, private capital flows are down by 32%. The peak was 10 years ago. So this is, when I looked at this number, this looked like news to me. The private equity flow is coming down because of largely foreign direct investment, and stock market flows are becoming negative, as you can see. They are more volatile and they have become negative. The stock market in developing countries, if you can say a strong word, is dead. I mean, it probably can be revived. I hope we can revive it. So the second message is portfolio debt flows through the bond markets that are also declining with an interesting twist that while bond market flows are low, volatile, and declining, syndicated bank lending, which is captured in the data, are actually going up somewhat, or they were flat, but they also have become more volatile. That is an interesting one. I'll talk more about that in a minute. What is surprising also is that bank lending now is a bit larger, slightly larger than foreign direct investment. This was also news to me. And the reason I say this was news to me, let me get to that in a second. Again, the flows, decline in private flows are because of north-south flows declining. South-south flows are going up. But interestingly, flows going to the upper middle income countries, that is, that would be countries that have a per capita income of just over 4,300. That's how World Bank defines upper middle income developing countries. In those countries, there has been a sharper decline in private capital flows and much more volatility. Compared to that, in the low-income countries and middle-income countries, in the LICs and MICs put together, FDI, foreign direct investment, is flat. I would have expected it to increase, but it is luckily not decreasing, but it is flat. Bank lending, on the other hand, is going through the roof in some ways, a very, very sharp increase. This part of a substitution of debt with equity flows, like foreign direct investment. So the substitution of debt to equity flows happened in the 1980s with the debt restructuring, if you remember, and that led to the emergence of the emerging markets, right? The bond market, stock market. The term emerging market was coined in the 90s, early 90s. That switch from debt to equity and the disintermediation of the banking system, bankers, so to say, financial intermediaries, that has changed. It has come back to the old situation, the bankers are back. This is a major structural change since the global financial crisis. The global financial crisis saw debt difficulties and a problem that if you are investing in bonds and the bond needs to be restructured, dealing with 100 or 1,000 bondholders, investors is very difficult, whereas dealing with 3, 4, 5, or 10 bankers is a lot easier. I think that is the main reason why this switch is taking place. It's a reversal of something that at least 30 years ago, when I started working on global finance, I thought was progress towards moving from the sort of institutionalized, relationship-based doing business towards something that is more market-based. That is being reversed, which is a structural change. South-South investment is rising significantly, and everybody thinks immediately China. It is, but actually it is happening at every level. South-South investment is going up. Turkey is investing in Central Asia. Nigeria, Kenya are investing in their neighborhoods. India is investing everywhere now. South Africa always was there. Brazil is investing, Colombia. So the South-South investment story is there and it is growing, and that has important implications for the way we should think about the future. So I'll come back to that in a second. So this whole point that flows are falling and there is a switch from equity towards debt, is that due to perhaps the interest rate dynamics, the global interest rate dynamics, the fact that interest rates were almost zero, sometimes negative, for almost a decade after the global financial crisis? And the answer is no. Is the decline in the flows, private capital flows to developing countries because of rise in interest rates? No, because that only happened about a year ago. So that's too soon. The data actually has been showing a decline in private flows for 10 years now. So it's more structural. So it's not related to interest rates. So what is the reason? And the reason lies in the fact that growth differential between high-income countries and low-income countries or developing countries, that is kind of compressing. It is tightening. It is vanishing. That story actually shows up here when you look at advanced economies, the dotted line, this is the growth rate, and then the low and middle income countries, the solid line. You see the last 4 years? This data, by the way, the LMICs, the low and middle income countries here includes, it does not include China. Now, you can see it's almost identical, meaning that there is no advantage to investing in developing countries because the relative growth rate of return, the higher rate, is not there anymore. In the meantime, risks have gone up of investing in developing countries. So indebtedness level of developing countries has gone up significantly, and especially so for low and middle income countries. That shows up even more starkly when you look at rating distribution of countries. 10 years ago, you can see the peak sort of modal number for countries, the highest rated countries, the highest number of countries rated, that was something like BB minus. That's kind of the middle of the risk spectrum. 10 years later, it has shifted to B minus. It is a shift of about 4 notches. And I'll show you in a minute, a 4-notch downgrade effectively means something like interest rate going up by 400 basis points or more. It's just incredible. So costs have gone up, riskiness has gone up, returns have fallen. So in that sense, private capital flows are not flowing for risk-return considerations. Private capital flows and investors are not always looking for sustainability and climate change and equity and all those good things, right? So by contrast to the north-south flows, remittances and south-south flows are going up. Remittances, that's a very unusual story. This is remittances sent by by migrant workers. And by now, remittances to developing countries, excluding China, that's the 2022 number, is about nearly 600 billion. And at that level, it is larger than the sum of foreign direct investment and official aid together. Moreover, remittance flows are stable and maybe even counter-cyclical, whereas foreign direct investment tends to be much more volatile and cyclical. So that is one interesting fact that we should take into account when we are thinking about resource mobilization for the future for developing countries. The other part is that cross-border payments are going through the roof in some ways, but they have also been very volatile. And cross-border payments here has been defined as exports of goods and services plus investment flows that are cross-border, plus official aid that is going in. So it's all the cross-border payments from one country to the another country, right? That number is like $8 trillion, $7.7 trillion, something like that. So there are some issues that pertain to remittances and cross-border payments together, and those issues are costs, foreign exchange markups, and problem with interoperability of payment systems. Remittance costs are high. On average, sending money to developing countries costs more than 8%. Sending money to Africa costs 10%, at least 8%. Sending money within Africa can be sometimes 20%. So remittance costs can be reduced and should be reduced, but for that, you need to address interoperability problem. Everybody has proprietary system, they don't talk to each other. That's why costs go up, there is fragmentation. And then there is this big story of foreign exchange markups and foreign exchange premia. The numbers that I mentioned on remittances, 650 billion now, 600 billion was in 2022. That number is officially recorded data only. If you included flows through informal channels, that number is much higher. And one reason flows are happening through informal channels is because of foreign exchange premias that are there in the black market exchange rate. So we have data here now on black market premiums in about 30 countries. And this data are being recorded on a regular basis now. This does not include all the countries where you have black market problem. When you have a better rate available through the parallel market, money will go into that channel. So this is a problem that we need to address. But related to that, there is a bigger problem. For foreign investors investing in countries where, or in projects where the receivable, the money coming in is in local currency, they have to bear the foreign exchange risk. So the currency depreciating, the depreciation risk. So that is one of the major reasons why costs are high. And can we address that, the foreign exchange markups? Can we address the whole issue of, the issue of very high foreign exchange risks or swap premia, so to say, for hedging the exchange rate risk? That becomes important for climate finance and energy transition and all that, because the receivables will be in local currency. So that is why it is so important. The final message is that official flows can actually help in terms of private capital mobilization, starting with a simple fact. Everybody knows this, but I think the value added of this chart is that it is a chart. Actually, it is data. It is estimated. So this is actually something that you can use for trading, I suppose. So what you see is, as sovereign rating, as risk rating worsens from AAA towards C, borrowing costs rise exponentially, but they rise with a jump. There is a sharp jump at the investment grade thresholds. I believe there are such jumps at other thresholds as well. It's just that I have smoothed it over in this presentation. So what can we do from this chart to help with private capital mobilization? Obviously, because of the exponential nature, if your rating improves in a linear way and your borrowing cost falls in an exponential way, you benefit. So that's basically one of the things. So if we do credit enhancement, if we provide guarantees, if we provide collateral from the private or from the public sector, we can reduce borrowing costs. So that is the way that we see a framework, a simple framework for mobilizing private capital with the help of MDBs. So one interesting idea from this would be noting that South-South investment is increasing, and the southern investors from the global south, they tend to have a more tolerant risk perspective towards investing in neighboring countries or in the developing countries? If so, then why don't we begin to think about helping investors from the global south? So that is one. The second is noting the fact that remittances are so large, diaspora savings are so large. Could we not engage with diaspora investors? Right now, diaspora investors are non-existent in the ideas of everybody, right? Everybody, including the MDBs. So that's something to think about, because one interesting fact about diaspora investors is that either they hate their country or they love their country. If they love their country, they love it way more than an institutional investor, even from a financial point of view. So the benchmark for them is deposit rate, not the LIBOR, not the SOFR. The risk spread is also lower because they have more favorable view of their country or investing in their country. In most cases, in some cases they hate them, so it's different. So that's the reason why you might be able to get some kind of a patriotic discount by engaging with diaspora investors. And finally, there are a lot of experimentation going on right now in terms of providing guarantees and innovative financing mechanisms, like the innovative financing facility for immunization, like the innovative financing facility for education, and then World Bank has recently launched something called portfolio guarantee. And in the report, we briefly mentioned about potentially scaling up the whole thing by perhaps thinking about an international guarantee facility. So that's basically what it is, but we have a challenge. And the challenge is, how do you increase market finance without increasing indebtedness, because those countries are already indebted. So how can we do it without making the problem worse? So that is where here are some ideas. Create a pipeline of investment-ready bankable projects, which means plain vanilla, our work with business climate, working with countries, structural reforms, infrastructure building, all the good things that MDB systems do. And if there are bad things they do, they should avoid it. That goes without saying. I said it. So second is making debt more tradable. This is important because if you offer partial credit guarantee kind of thing, the things are not tradable. So that has implications for leveraging capital. So lending is okay, but if you're thinking about guarantees, you need to think about tradability aspect of it. Foreign exchange risks, I already mentioned that. How do we reduce foreign exchange risk? Not clear yet, but I have a feeling that if you do South-South engagements, diaspora engagements, you will automatically have some kind of foreign exchange risks taken care of automatically. So if India is depreciating, Indian rupee is depreciating 5%, and let's say Bangladesh rupee is depreciating 7%, Indians investing in Bangladesh, the devaluation is 2%. So something to think about. Diaspora investors don't really care much about devaluation. That's something because they can use the money back home. Finally, one of the things we could explore is offloading mature loans that multilateral development banks have past the greenfield risks to the market, so that we free up our capital, which can be reused for expanding lending. And finally, back to the point, engaging with South-South investors and with non-traditional investors like the diaspora investors. And this is where sovereign wealth funds from the South as well, they come in. So that's basically the message. And absolutely the final chart. If that is so, collaboration among MDBs can help. And an interesting factoid, so to say, everybody knows this, but nobody has seen this before, I think. Leverage ratio, loan to equity ratio tends to be 1 for IDA by definition, by design. It can go as high as 16 times in the case of MEGA. So infer what you want to from that. Collaboration will help, and here are the 3 messages that I tried to communicate. Thank you.
Thank you very much for a very insightful presentation and using data it's very hard to get data for, 22 years, right? And so I would like to open it up to see if there are any direct questions from the audience, clarifications, and then I have some questions for you as well that I was going to ask our speakers. So please introduce yourself and ask your question. Thank you.
My name is Jibril Fall. I'm visiting professor in practice at the London School of Economics. Dilip, can you kindly confirm whether past, current, and potential inflow of remittances are considered as a factor in sovereign credit rating? And if yes, to what extent is it being used, especially in LMICs? Thank you.
Thank you. Can you please? Yeah. We'll take a few questions and then bring it back to Dilip. Thank you.
Thank you. I'm Ignacio Corlazzoli, manager from CAF, Latin American Development Bank. I was wondering, when you mentioned, we were mentioning investment from South country, and you were referring to neighboring countries, but are you also considering South to South? I mean, within Asia, you have certain integration, but within Latin America, for example, there's much more to do. So, but you don't, I mean, are you considering as well, for example, investment from the Gulf countries to Latin America or to other regions beyond neighboring countries? Thank you, and congratulations.
Thank you. And I'm willing to take one third question. If there are any. Okay. Excuse me? This one here.
Hi, I'm Jeff Slugamelch with the National Center for Disaster Preparedness at Columbia University. And we're doing a lot of work on different kind of vulnerability indices, and particularly around, trying to open up concessional financing, looking at multiple dimensions of vulnerability. And I'm just curious, selfishly and more generally, sort of how you see, or if you see these types of indices sort of weighing in on the types of decisions that are made and the types of investment decisions. So any thoughts are welcome.
Excellent. Thank you. Dilip?
Thanks.
You got the question? About indices on vulnerability, and how do you see those playing a role in the analysis?
Well, thank you. Jibril, and the question on remittances and creditworthiness, when good data become available, rating agencies are following that. And I saw evidence of an improvement in credit rating significantly in the case of the Philippines and in the case of Bangladesh when it got newly rated sometime in the late 2000s. Now, when your remittance data are not properly reported, then obviously rating agencies rely on us for the data, and if it is not there, then they don't take that into account. So that is a fact. Now, another interesting similar application of remittance data is in the IMF World Bank debt sustainability analysis. It's a very formal process, as you know, and it's really used for our engagements and the entire official sector's MDB systems engagements with client countries. In the IMF debt sustainability, World Bank debt sustainability analysis, this is joint between the two institutions, remittances are featuring in explicitly now. And in one of our recent reports, we did some regressions to show that if your remittances are properly included in the rating analysis, then ratings can improve significantly by sometimes 4 notches. Again, that has implications in terms of borrowing cost, 300, 400 basis points, right? So it is being done, but not fully yet, because data on remittances are undercounted in most countries, and especially when countries begin to have debt difficulties. Before that, they have exchange problems, balance of payment problems, and because of that, their rating goes down. So low rating also means black market premiums and money going underground and remittances falling. So there is that strange dynamics also. This was a long answer, but I think it's very pertinent. That's why I thought I would explain a bit further. On the South-South investments, if I understood your question, you are asking about whether investment from the UAE to other countries are considered South-South or not. Yes, it would be, although in my definition of South-South, we limited ourselves to the developing countries. So we call it low and middle income countries as defined by the World Bank as, let's say, this is our definition of global South. Then you have high income OECD countries. So OECD members of the high income countries, so you can call them the traditional global North, conventional global North. And then you have the non-OECD high income countries, which is where you will have a whole lot of GCC donor countries, GCC countries, as well as Singapore, Korea. And now in that list, you would have even Chile and Panama and Hungary and Poland, because they're high income now. So it's a very, very narrow definition or very explicit definition. What I have in mind here is actually, obviously it means South here is more inclusive. So it includes the investments from non-OECD high-income countries to developing countries as well, or among themselves too. So that's also very important. The third question is about indices on vulnerability. I have not paid attention to that at all. And one message that we got when we had a roundtable on this paper in November, this was from JP Morgan, a message that came through was, I would say, chilling, in the context of, climate heating up. And the chilling message is that investors don't care. So we are looking into whether this whole idea of impact bonds, the green funds, all this talk about ESG compliance and all, is it really translating into lower borrowing costs? Is it really meaning more money for the right purposes, or is it just, call it greenwashing? That part is a question to be analyzed. I have not seen a definitive piece of paper. Also, I have not seen a definitive piece of estimate saying that global climate finance is so much. We have actually a whole section in the report where we show that the climate finance is supposed to be around, I believe, 980 billion or something globally. Developing countries, it's only about 80 billion. And carbon credits, we have some discussion of that. Also, that needs to be thought through because every now and then you hear about greenwashing and those issues, and standards and voluntary compliance kind of issues are coming up.
Thank you. Thank you. Yes, sir. We'll take another round, up to 3 questions if there are, and then come back to Dilip.
Hi, I'm William Goes from Migrant Forum in Asia. Dilip, I know you keep with this graph of remittances growing and it keeps growing and there doesn't seem to be an end trajectory of its growth. But I'm wondering because from where working with migrant workers and an organization that works across migrant workers in the Asia region, we see more and more deployment of migrant workers in the low wage kind of category. And over the years, we have not seen a rise in wages as well. So I'm wondering, in your trajectory of remittances growth, is that data disaggregated in the sense of who is remitting? Which category of workers is remitting most kind of thing, for us also to see how these countries of origin, how are they being sustained? Their credit worthiness is growing, investment is coming in, but is it impacting the poor in those countries? Is it elevating that? Is there some analysis or your thinking on that?
Okay, thank you. And if you don't mind just handing it up to the front row. Yeah. Thank you.
Yes, hello, my name is Lincoln. I'm from Brazil. And you talk about something very interesting about the climate agenda. So we all look to the climate and then we get money and invest on lowering the pollution in the world, okay? But shouldn't we look those investments for by the lens of human development? Because I think the justification is good. It's climate, it's on the top of it, but at the end, poor people with low income, they are caring about basic needs and basic infrastructure, and they don't really care about the climate. Shouldn't we look from those perspectives first? Thank you.
Any? Okay. All right, Dilip,
Yeah,
over to
well,
you. Thank you.
Thank you. So on the, William, your question on who is remitting, basically. Honestly, I don't think there is proper research yet on that topic. There are sort of ad hoc studies, one-off studies, let's say in country X, so, and that would be a large number of countries now, developing countries, where you would find that rich people don't send so much money. In fact, one of my own papers, I found that rich people remit money to where they go. So they, in fact, don't even migrate. Whereas very poor people also have difficulty paying for the recruitment fees and the travel cost, the migration cost, so they don't migrate. But then just above that, in the middle, and especially below the median, lower skilled migrants tend to send a lot more money, and there are also so many more of them that a large amount of remittances or the growth of remittances is coming from the growth in the number of lower skilled migrants. It can be inferred very easily from all those findings. Even if wages are not rising, they have migrated to a country like, let's say, the UAE, from, let's say, Bangladesh or from India. They have migrated motivated by the desire to send money home. So, in fact, they do that. So, remittances is the reason why they migrate and is the result of their migration. So, it works out that way. And they send almost everything they earn back home. So even if their wages are going up, but at the margin, the number of lower skilled workers are going up, which is the case, remittances are going up. What is interesting now, which is what I presented day before yesterday in the Abu Dhabi dialogue here, is that outward remittances from the GCC countries is actually, it has become flat since 2014. It is one of the largest source of remittances in the world. So if you take person for person, meaning that remittances per capita kind of thing, remittances divided by population, remittances divided by GDP of the country, outward remittances from Saudi Arabia or UAE would completely overwhelm the number compared to the largest source of remittances, which is United States. So a large amount of remittances goes from the region out because also the region is so dependent on migrants. But the fact is that since 2014, the outward flows of remittances have become flat here, whereas remittances from rest of the world, so particularly from the United States, is going up significantly. So that part seems to have a lot to do with IT workers and the middle level of people, and I think a bit of that must be also because of the remote work and online gigs and all that is happening. So those are some of the factoids about remittances. Going forward, and I don't want to spend all the time talking about that. Going forward, in fact, we should bear in mind, if 1 billion people are going to join the working age population in developing countries, most of them in Africa and in South Asia, 1 billion people joining the working age population in 20 years, migration pressures will increase, informality will increase, most of them will come from rural areas to the cities, and from there, or even before that, they will cross the borders and go to big cities all over the world. So urbanization will increase, informality will increase, migrant populations will increase, gig work will increase. They will send more money home because they wouldn't be able to bring their families with them. So remittances are going to grow through the roof. I cannot imagine them falling. I actually see a bend the other way towards increasing. So that is something we should pay attention to because we are thinking about mobilizing hundreds of billions of dollars, and you can't forget the elephant in the living room, which is what it is right now, remittances. That brings me to the question about Brazil and climate focus versus focus on human development. You are absolutely spot on. I mean, we are, as development institutions or as human beings or as economists, we are in the end looking at human welfare and welfare of the people in developing countries as well as welfare of entire humankind. So in that context, climate finance is an intermediate step, I suppose, to avoid the kind of chaos we had today here. It's not related to climate change, but such things are happening more and more. So I think it is a good idea to think about climate and put focus on climate, and really put the money where actually it produces results. And I think that would directly benefit also human welfare. I don't see a trade-off there. The trade-off would be if you say that in developing countries you use less electricity now or less fuel, whatever, and then you say in the rich countries also it's okay to have to burn fuel for electricity. I mean that obviously is not right. So we have to keep that perspective, I think.
Yeah, and actually, let me just add to your question, Malcolm. I think the more you usher in private capital and private finance, you also liberate some of the resources to be invested in human capital, right? And so the idea is how can you usher in more investments in developing countries that can be done by the private sector to free up some of the financing from government to actually invest then in health, in education, in social protection programs. So as Dilip was saying, I don't see it as an either or. I think it's an important agenda. When we're talking about climate finance, we're also talking about human development and human capital. Ultimately, the poor people are the ones who will be hurt the most, right? And so, and that's our mission as a World Bank group, right? And it's addressing poverty, but in a livable planet. And so you can't separate the two. Any other questions? So I have a question for you.
Not too difficult, right?
No, not too difficult. But I think from what we're hearing and what you presented, as a World Bank group and other multilateral development banks, with the GCC leading on the agenda on this energy transition, and you spoke about remittances that have been flat from this part of the world, do you see a different approach? Do you see potential for greater private investments around the world from GCC countries to try and help this transition?
Absolutely. I actually think that there is so much ability in the GCC countries to invest abroad. Right now, a lot of that is going to the developed countries. And if poorer countries are benefiting mostly through remittances, which is a private effort, we have not institutionalized or we have not properly organized government investment policies towards investing in developing countries. And it's not only government investment, public investment, also public sector encouraging semi-public or private companies, or enabling them through different kind of mechanisms like guarantees or collateral provision or project design. So that, I think that's a very important agenda to somehow foster more private capital mobilization from the region to the developing countries. The other part is also the region here needs a lot of investments as well in its plan to diversify the economies. And that would require talent, that would require money, technology. And sometimes technology and money investments, you can't really separate them. Technology won't come just with money. So you have to bring them in. So there is that need for also attracting inward investments in the GCC countries from the rest of the world, including from developing countries.
Excellent. Okay, so any last minute questions, comments? Last minute thought. Can we get a mic for the gentleman up front, please? Thank you.
Thank you, Dr. Dilip. On the remittances point, one of the reasons, maybe, I'm just thinking aloud with you, is that the governments of the GCC countries have been trying to entice the expats to spend locally in the real estate sector and so on. So everything you see in Dubai here is, probably owned, by expats and not necessarily FDI into. So this is one. And the other factor is that some of these countries, just like my country, Sudan, is politically so unstable. So we stopped remitting to Sudan and so on. But these are two factors I think we should have eaten away from, the amount of, remittance, which is, there must be some more, I'm sure. Thank you.
Thank you so much. I think, I just noticed the screen in front of me, which I wasn't looking for. It seems time has been up for the last 17 minutes. So please, Dilip is here, so after the session, you can have a conversation with him. But thank you all so much for attending this session. And thank you very much, Dilip, for this insightful presentation. The publication is there. You will see on your seats a summary and where you can download it, correct?
Absolutely.
Okay, thank you all so much. Yeah.
Thank you. Thanks, Safa.